Now we turn to Europe, and we always like to kick off with the Eurozone aggregate data and look at some of the things that have come out. So the ECB had their meeting. I don't think it's any surprise in terms of where they kept their rates. It's just what is that forecast going to be going forward that is more important. And before we get into that, we just want to look at industrial production for July. You know, as we were saying, it's up 0.6% was the estimate, 1.5% was the throughput. That was a better surprise that we expected going into July. But then as we come through August and September, that's where we start to get some of that additional pressure from car manufacturing, especially on the German front. But let's talk about, what is going to happen with these easy rates with the PEPP. So 8 EU countries signed a letter in support of reducing debt levels. So that is going to become a much bigger issue when you start looking at how do they come to terms with what is happening right now, because France, Italy, Spain, they don't want it. I mean, and that's the bigger issue at this point, because the letter is by countries that have done well, have carried out austerity, have been very good at managing their system. And they don't want to fall under a lot of these issues and caveats that we've seen and pressure points. But this is the disconnect between Northern Europe and Southern Europe, where Southern Europe is spend heavy, spend thrifty. And then you look at Northern Europe, we're like, hey guys, let's calm down a second. Let's look at what our debt levels are. Let's look at what inflation is doing. Let's weigh what we want the economy to be doing going forward and at what GDP to debt ratio. And this was some of this sort of meat in the middle. Now, I agree where I wouldn't really call this tapering, but it is kind of that revamp of how are they going to purchase these assets. So a revamped asset purchase program could be used to offset the end of the pandemic emergency purchase program. So they would still have some APP, but it wouldn't be under that PEPP side, which is that pandemic emergency purchase program. So the ECB will trim emergency bond purchases over the coming quarter, taking a first small step towards unwinding the emergency aid that has propped up the Eurozone economy during the coronavirus. After the ECB pulled out all the stops last year, you're starting to see some of this adjustment. ECB did so by slowing the pace of its PEPP, which has kept borrowing costs low as governments took on unprecedented amount of debt to finance the response. With the economy now on a stronger footing, the ECB said that favorable financing conditions could be maintained with a moderately lower pace of asset purchases compared to the 80 billion euros it bought per month during the past quarters. It provided no guidance for the 3 months ahead, but 3 sources with knowledge of the discussion said that policymakers set a monthly target of between 60 to 70 billion euros with flexibility to buy more or less depending on market conditions. So that's why if the market starts to worsen, they'll step in. So that's why it's kind of like a temperamental cut, if you will, or easing. And this is where the projections will start to see some of the slowdown as we go forward. And that's where you can see that those net purchases or the stylized projections from Fitch Ratings is seeing, at the high end 80, but likely to see some of that coming down closer to 70 over time. And then the net asset purchases or the net APP purchases can be maintained through this purchase. And you could see some of that increase again and take down PEPP purchases, but increase APP purchases. So many purchase programs, and in order to try to supplement some of this movement. So looking at it a little bit different way, when we look at that APP versus PEPP side, that's where you can see some of that replacement with one into the other, providing that forecast. So on the PEP side, you would be buying only 60 to 70 billion, and you would increase your APP buying by 10 billion to provide similar coverage, but through just a different bucket. Still, again, keeping the rates low and keeping things easy as everybody continues to essentially buy blindly. So when you look at the share of how is this impacting individuals, so share of private household deposits subject to negative interest rates in selected countries, 91%. So 91% of private households are getting hit with negative rates. But then the share of corporate deposits subject to negative rates is 57%. So the people are taking in an abnormal amount of pain due to the interest expense. And that's essentially saying that you have to pay to keep your money there in negative interest. Otherwise, you have to put it into the market to yield something above. But then how do you pay bills? How do you bridge a gap if you lose a job or you want a down payment? So essentially, you're getting penalized for putting together a down payment in Europe, which again is incentivizing all the wrong things. And then the expected growth of labor force between 2020 and 2035, the U.S. is supposed to see about a 2.5%, which comes down to the issue that we talked about previously. When you look at the amount of jobs that we're going to grow or we're supposed to add by 2035, which is essentially just replace everything that we've lost during the pandemic. But then when you go through Europe, you can see that there is a big loss in the labor force, which has to be fit, because if you look at just the jobs, and then you look at just where growth is, and where you look at the underlying capacity shift and how things continue to be essentially be moving, you're not going to see that growth in labor force because children are not being born at the same rate. The birth rate is well under 2, and you need about 2.1 to keep things flat, 2.3 or so, 2.4 to see population growth, and that's child per woman. So if you're at below 2.1, you're now seeing a decline in your population. Some of that can be made up with immigration and some of those movements, but you're still seeing that net pain in general that is accelerating not only in China, but Japan, Germany, and Italy. So then when you look at factories across the Eurozone are reporting shortages. Now let's consider what those shortages are on 2020 versus 2021. So when you look at Germany, it's over 70%. A lot of cars are made in Germany, and that's where we continue to see a lot of this shortfall. But when you look across the board and look at the EU, so in the EU, August 2020, they were at about 9%. Now they're at about 35%. So you're just seeing, again, that the supply chain creating these issues that have to be replaced, have to be fixed in some shape, way, or form. And it's just very difficult to do so right now with shortages of material and equipment are reported in many EU industries. Motor vehicles was at about 7% on average from 91 to 2000, and right now it's about 60% in August of 21. Electrical components, machinery, again, none of this is surprising. It's just showing how far behind we are globally, because we talk so much about the U.S., but it's not just a U.S. problem. It is also something that is very easy to see within Europe as well. And then a record share of EU manufacturers report insufficient materials and equipment. So across it, right now, it's at about 40%. And then the per capita income has stagnated within Italy. And then when you look at the European Union and the OECD, you've had some of this come back, but per capita income is not. And this is what happens with inflation. So you're just looking at how inflation can impact others just based on what is their income, what is the wealth capacity, what is their ability to get some of this growth and to better themselves with a better job or a job of this. And you're seeing more displacement, you're seeing more pressure in general, which is creating this stagnation where we're just not getting that real growth that we saw. We're really back to where we were in 2018, but inflation in 2018 and inflation today really adjust that spending capacity, which is what we continue to talk about on the wage side and the wage compression. So now getting a bit more specific, looking at Germany. So when we look at August, you can see that August CPI kind of right in line with where things were year over year, 3.9% was expected. That's where it came in. But the wholesale price index is the biggest concern, because the wholesale price index last month was 1.1%, came in at 0.5% this month, still an increase with wholesale price index year over year. Last month was 11.3%, came in at 12.3%. And just based on everything we've just said on shortages, equipment, materials, it's only going in one direction when you look at the underlying pricing overall. So then when you look at electricity prices. So electricity prices, when you look at German in general, going back to 2003, this is the highest price they've ever had of euro per megawatt hour. And shockingly, it went up again today. So then when you look at German PMI new orders versus ISM new orders and China credit impulses, you get an idea of kind of where these things are going and the pressure that is coming to not just to the European theater, but just across the economy in general when we're looking at what that demand profile is going to look like. Then when we turn to France, you can see things continue to slightly better, slightly worse on the industrial side. Industrial production, 0.4. It came. Its estimate was for 0.4. Came in at 0.3. Manufacturing production estimate was at 0.2. Came in at 0.6. Then CPI was right in line with where they were expected, but we did see some of this improve coming through August. So again, you're seeing some of that improvement in France while some of the pieces slow down on the German side. Then when we look at Italy, industrial production again was expected at negative 0.1, came in at 0.8, getting a lot of that production. Again, Italy remains kind of that bright spot in general. With unemployment rate quarterly, expected 10%, came in at 9.8, where when you look at CPI, coming in right in line as well. But more importantly is when we start looking at France. So let's talk more about more than half of French firms report hiring difficulties, but yet they still have a high unemployment rate. And it's only gotten worse when you look at where things started in May and then where they sit in August today, with about 50% of firms reporting hiring difficulties. This is what we keep talking about on pricing, on wages, on what people are willing to do. And it's not just the U.S. that is seeing these issues. It is a global problem that, again, is going to be addressed at some point. I don't know if it's just companies saying, look, we have to hire the next person regardless, and hiring them and worrying about training them, or people just saying, look, I need a job regardless because the stimulus is going away, and they're going to take a job that they may have not, they didn't want to take, but they had to because of circumstances. A lot of these things are going to have to play out over that time period. Now, just kind of rounding it out, when we look at debt to GDP will rise to new highs. When you look at just across the board, 2019 and where that we're going to be in 2022, it's going up again. Again, deficits are huge. They were huge in 2020. They're going to be big again in 2021, and they're going to continue in 2022 as the OECD continues to add debt onto their balance sheets, and the market continues to say, what does it matter? It's fine. So again, these are overhangs as we look towards future growth. And when you look at just the supply chain issues, the inflationary issues, the problem across the board, there are going to be a lot of headwinds to achieving a lot of this growth, which is going to make it difficult to increase GDP to close this. Because if you increase GDP, this gets better. And I think this is clearly kind of saying that even if GDP does get better, there's still a lot of debt, there's still a lot of this uncertainty, which is going to continue in the market. So now that we talked about Europe, we want to turn to Asia and do a broader stroke on what is happening in Asia with a big focus on China, Evergrande issues, and what does that mean going forward.